Hi guys, welcome to a simpler approach. If you're new to the channel, I ask that you like, subscribe, comment and share. Today, we will be looking at control accounting. Let's get started. There are two objectives for this lesson. Number one, to understand the concept of control accounts, and number two, to differentiate between creditors control and debtors control accounts. Before we dive into this, however, there are two things that we must recap. Number one, double entry. Remember now that double entry is the process of recording a transaction twice. Once on the debit side of an account and once on the credit side of the corresponding account. Remember also that T accounts, this thing right here, is the place where all information relating to an asset, liability, capital, revenue, or expenses are placed. All the information is placed right there. That's number one. Number two, debtors and creditors. Our debtors are those individuals that owe us money, and by us, we mean our business. Creditors, the flip side of the coin, are those individuals or businesses that we owe money, and by we, I mean our business. Okay? Now, place these two things not so far away in your mind. We're going to come back to them in short order. Awesome. So, control accounts. There is a major advantage to businesses that are small in nature and in size. And that advantage is that they can use one single ledger to adequately reflect the accounts that they have. For those who are wondering what a ledger is a place where all the T accounts for an entity are kept. Now there are four types of ledgers: the sales ledger, the purchases ledger, the general ledger, and the cash book. Now, I'll just tell you quickly what those are. The sales ledger is the place where the T accounts for all the individuals and businesses that we sell goods on credit to are placed. Purchases ledger is the place where the T accounts of all the individuals and businesses that we purchase goods on credit from are placed. The cash book is a journal. It's the only journal that's both a journal and a ledger, and that is so because there are two T accounts in it: the cash account and the bank account. The general ledger contains all other T accounts. Okay? Awesome. Over time, as the business increases in size and accounts, it gets to the point where the single ledger system that was being used when the business was small is no longer adequate to reflect the business's size and increase in accounts. So what becomes necessary now is a separation of the ledgers. There is no a need to operate various ledgers. Now, when that happens, it opens up the possibility for errors to be made. Now, in order to test the accuracy of each of the ledgers, there needs to be a type of system that will allow for the location of errors swiftly within these ledgers. That process is accomplished by using control accounts. Now, there is one underlying principle to control account, and it simply is this: if you know the opening balance of the account, if you know all the information that is in the account, whether it is debited or credited, added or subtracted, whichever the case may be, Once you know all of that information, then you can calculate what the closing balance should be. Now, if you do the calculation, and for argument's sake, the closing balance should be $2,000, and you get $2,000, it means that the ledger is fine. However, if you know the balance should be 2,000, and having done the control account, the balance you calculate is not 2,000, it therefore means that there is an issue within that ledger. There are two types of control accounts. The first one is called the sales ledger control account, otherwise known as the debtors control account. Now, this control account, it targets the sales ledger only, and its purpose is to confirm if there are errors in it or not. Now, in order to prepare this account, you need the opening and the closing balance of all debtors. To get that, you take it from the sales ledger, because remember that the sales ledger contains all the T accounts of our debtors. So, get the opening and the closing balances from the sales ledger. Credit sales information, we take that from the sales journal. Now remember now that the sales journal is the book where all credit sales is placed. And by credit sales, we mean when we sell goods on credit, that's where we put the information, the sales journal. We need returns inwards, and we get that information from the returns inwards journal. We need information relating to all cash and checks that were received from our debtors. We take that information from our cash book. We also need discount allowed. Any discount that was given to our debtors for purchasing from us, whether in bulk, on credit, cash discount, whatever the discount may be, that information is in the cash book. Okay, now when we round up all of that information, this is what we are preparing. This is the outline for the sales ledger control account. In order to accurately process all the information that you are looking at, allow me to give you a map, a tool, if you wish. The sales ledger control account is done from the debtor's perspective. Let me say that again. The sales ledger control account is done from the debtor's perspective. What do I mean? In whichever way it affects the debtor, that is how you think about it. That is how you look at it when you are dealing with the sales ledger control account. Let me give an example. Let us use this one, credit sales. Now, the reason why we're not using our balances is because our sales ledger primarily has debit balances, because our debtors have debit balances. Now, it is possible for our debtors to have credit balances. Yes, it is possible. But when you get information to prepare sales ledger control, if the information just says balances, sales ledger balances, it is a debit balance by nature. However, if it is a credit balance, the question will tell you. Okay? Now, credit sales. Credit sales, how do we look at this from the debtor's perspective? Okay, journey in your mind with me for a second. We sold some goods on credit to John Brown. The name of our business is Martin Services, just for argument's sake. So, Martin Services sold some goods to John Brown. Now, when this information was being written in the T accounts, recall our double entry recap that we did a few minutes ago. Remember that we said Double entry is the process of recording a transaction twice, once on the debit side of an account, once on the credit side of a corresponding account. Now, when we were recording that sales transaction, sales account is always credited, which means that when we opened our sales account, we would have credited the information there. And when we opened John Brown T account, we would have debited the information there. Now look and see, where is this information? It is on the debit side, is it not? Yes, it is. So you see, what you are looking at here only affects the debtor. So in the debtor's T account, credit sales is debited. Dishonored checks are checks that were paid to us by our debtors, but unfortunately, they are no good. They are bounced checks, for want of a better way of saying it. So when that happens, the debtor's account is debited. Bad debts recovered. Bad debts recovered are situations where bad debts that are debts that we realize we are unable to collect from our debtors for whatever reason. As time progressed, our debtors came forward and said, hey, we are now able to pay. So having written off the bad debt, we have to reinstate it and then collect it. Now the process of recovering it is debited. That is placed on the debit side of our debtors. Interest on debt. When they owe us and don't pay on time, and interest is charged on what they owe us, that is a debit entry. When we refund cash to our debtors, that's a debit entry. Return inwards, bad debts, receipts from our debtors, whether by cash or by bank, discount allowed, all these things are credited in our debtors T account. Now finally, set off. Set off is a situation where it is possible for us to buy from our debtors and sell to our debtors. Now, instead of selling our debtors and collect money, and then when they purchase from us, we are paying them, we just have what is called like a trade-off. So I sold some goods to my debtor for 5,000, and in 2 days' time, I bought some goods, different goods, from my debtors for 4,000. So 5 and 4. So what we do? We just set off. We just squeeze out the $4,000, right? So that's the concept of set off. In plain terminology, squeeze out. All right. Now, when you think about these things from the debtor's perspective, it helps you to formulate the information in a more logical and coherent manner. It makes it not so much cumbersome to think about and to process. Once you use the concept that the sales ledger control account is done from the debtor's perspective. Let us look at an example. Here we have sales ledger balances of 5,000, and remember this represents the sum total of all the balances of our debtors. Okay, we have the sales day book 12,850, and remember sales day book is the same thing as the sales journal. We have returns inwards 550, cash and the checks received from our debtors 11,500, discounts allowed 400, and this now, look at this right here, this 5,400. This represents what the closing balance of our debtors should be. Now, when we place all these figures in the sales ledger control account, it is supposed to be automatically balanced. If it is not, it therefore means that there is an error located somewhere in the sales ledger. Now let's see the result. Awesome. Now this means that there are no errors in the sales ledger. How do we know this? Because these two figures, 17,850, 17,850, they are the same. The account is automatically balanced. And remember again, when this happens, it means that there are no errors in the sales ledger. So let us toggle between the two for a second and shed a little more light on what we're looking at here. So, sales ledger balances, debited 5,000. All the entries in the sales day book, debited 12,850. And remember now that we are doing this from the debtor's perspective. So everything that you're looking at right here is how they would appear in the sales ledger. Returns inwards, credited 550. All the cash and checks received from our debtors, credited. Discounts allowed, credited. And remember, all these things are credited in the debtor's account because they are debited in their respective places in the corresponding account. That would be the returns inwards for this one, the cash book for this one, and the cash book for that one. Okay, and then the balance is 5,400. Now remember that balance represents BD, that's the balance brought down to the next month. Now in order for BD to be calculated, CD must be done first. All right, so to summarize all of what we're looking at here, all the entries are placed in their correct place. And seeing that the account is balanced, it means that there are no errors in the sales ledger. Okay, so we'll now move on to the purchases ledger control account. The second type of control account is the purchases ledger control account, otherwise called the creditors control account. This control account targets the purchases ledger, and its function is to ascertain whether or not errors are located in the purchases ledger. Now, to prepare the purchases ledger control account, you need the opening and closing balances from all creditors. That information is taken from the purchases ledger. You need the credit purchases balance. That is taken from the purchases journal. You need returns outwards, taken from the returns outwards journal. You need all cash and checks that are paid to suppliers. That is taken from the cash book. And discount received, discount that is given by us to our creditors. That is also taken from the cash book. Now, when you take all of that information, this is what you do with it. This is the purchases ledger control account, the outline. Remember when you were being taught the sales ledger control account, you were told that the sales ledger control account is done from the debtor's perspective? Well, the purchases ledger control account is done from the creditor's perspective. How does it affect the creditor? Let us look at this section as an example, and we're going to focus on cash. The same concept would apply for bank, so let's just focus on cash. The creditor's perspective. Now, naturally, we would have bought something on credit from our creditors, which means that we would have owed them for what we bought on credit. Now, when the time comes for us to pay them, two accounts are necessary: cash account and the account of our creditor. Now, when recording the information, we would have credited our cash account. Why? Because cash is going out. And when an asset, which is cash, when an asset decreases, you credit. So you would credit the cash account and you would debit the creditor's account. So if the creditor's name is Jason Myrie, we would have debited Jason Myrie's T account and we would have credited the cash account. Now, take a look at which side this is recorded on. This is the debit side, is it not? Yes. So, when we say we are looking at the creditor's perspective, we mean you are looking at and taking note and bearing in mind when you are doing the purchases ledger control account, the information is recorded from the creditor's perspective. How is it recorded in the creditor's T account? That concept goes for everything that you see here. Returns outwards is debited in the creditor's account. Discount received is debited. I'm going to come back to set off in a second. And purchases is credited in the creditor's control account. And for those who don't remember, purchases is always debited. So if purchases is debited in the purchases account, naturally it must be credited in the creditor's account. And this is the sum total of creditors, which means purchases is credited. Now let us come back to set off. The concept of set off remains the same as we explained it in the sales ledger control account when we were studying that. We said that set off is a situation where we purchase goods on credit from somebody and we also sell them goods on credit. When that happens, instead of paying here and receiving payment there, we just squeeze, as we would call it in plain terminologies. We would just squeeze out the balance. So I purchased $10,000 worth of goods from Jason. And then 2 days later, Jason purchased $9,000 worth of goods from me. What we do, we just squeeze out the $9,000 and only the $1,000 will be taken care of. Okay? So that's what the concept of set off means. Okay? So we're going to look at an example now and place all of these X's into figures and we'll make it a little clearer. This is our example. Okay? Purchases ledger, balances, 9,600, taken from the purchases ledger, of course. And remember, this is the sum total of all creditors. Purchases day book, same thing as the purchases journal, total 6,790. Returns outwards, 500. Cash and checks paid to our creditors, sum total 6,000. And discount received, $90. Now, once again, we've been given what the closing balance is supposed to be. The closing balance is $9,000. Okay, now if we put all of this together and it's not automatically balanced, as we saw with the sales ledger control account, it means there is an error within the purchases ledger. Now let's look and see if there is an error. Yes, there is an error or multiple errors in this case. How do we know this? These two figures are not the same. Now, as we saw with the sales ledger control account, we saw that the information provided a perfectly balanced T account, which told us that there are no errors therein. Now, that same concept applies here. However, we have two different figures in the end. Now, based on the fact that these two figures are supposed to be the same, it means that there is an error within the purchases ledger. Now, let us toggle between what we're seeing here and the example and break down what is happening. So, purchase ledger balances on the credit side, and this is on the credit side primarily because our creditors have credit balances. Their balance BD should primarily be on the credit side. Now, it is possible for our creditors to have debit balances, and that situation is a case where we would have overpaid our balances to our creditors and would therefore mean that they now owe us. So I purchased $10,000 worth of goods from my creditor, and in the process of payment, I ended up paying $12,000. It means that my creditor owes me $2,000. In such a situation, the balance would be on the debit side. Otherwise, credit side. Purchases day book, sum total, $6,790 on the credit side. Returns outwards, cash and checks paid to our creditors, and discount received, all placed on the debit side. Why? Because when this information is being recorded, it would have been placed on the debit side of our creditors. And lastly, purchase ledger balance, $9,000. This is the closing balance. Now, if balance BD should be on the credit side, it means balance CD is going to be on the debit side. Okay? Now, when you add these together, you get $15,590. And when you add these two together, you get $16,390. As we said before, these two, this one right here and this one right here, should be equal. And the fact that it is not means that there is an error within the purchases ledger. That's it for today. That's it for the sales ledger control account and the purchases ledger control account. I hope that the information was clear, and I hope that you learned something. If you liked that video, please like and comment. And once again, if there are any concerns or questions that you may have, please feel free to share them in the comments section below, and I will respond to you directly. Until next time, walk good, stay safe.